The choice between a 15-year and a 30-year mortgage isn't just about how long you'll be paying. It's about hundreds of thousands of dollars, your financial flexibility, and how quickly you can build wealth through home equity. Most people default to the 30-year simply because the monthly payment is lower, without truly understanding the long-term cost. But what if that lower payment actually costs you an extra car, or even a college education for your child? We're going to break down the exact math, showing you how a seemingly small difference in interest rate or term can lead to a colossal sum over time. This isn't just theory. We're using real numbers for a typical US home so you can see the stakes. Get ready to uncover a financial truth that could reshape your entire homeownership journey. Let's start with the 30-year mortgage, the most common choice. Imagine buying a home for $400,000 with a 20% down payment, meaning you're financing $320,000. At a current interest rate of, say, 7% for a 30-year fixed loan, your principal and interest payment would be roughly $2,128 per month. Over 30 years, you'd make 360 payments. If you multiply $2,128 by 360, you'll find that you pay a staggering $766,080 in total. Remember, you borrowed $320,000. That means you paid $446,080 in interest alone. That's more than the original loan amount. This number shocks most people, and for good reason. It highlights how much of your hard-earned money goes directly to the lender. But is there a way to drastically cut this down without extreme sacrifice? Let's look at the alternative. Now, let's switch to the 15-year mortgage using the same $320,000 loan amount. Typically, 15-year rates are lower than 30-year rates because the bank takes on less risk for a shorter period. Let's assume a 6.5% interest rate for the 15-year fixed loan. Your principal and interest payment would jump to approximately $2,776 per month. Yes, that's a significant increase of about $648 per month compared to the 30-year option. However, here's where the magic happens. Over 15 years, you'll make 180 payments. Multiplying $2,776 by 180 gives a total repayment of $499,680. Compare this to the $766,080 for the 30-year loan. You're saving a colossal $266,400 in total payments. The interest paid drops to $179,680. This massive difference is often what makes the 15-year mortgage so appealing, but it comes with a trade-off in monthly cash flow. So, how do you decide if it's right for you? The core difference boils down to how interest is calculated over time. With a 30-year mortgage, because you're paying back the principal so slowly, a much larger portion of your early payments goes towards interest. Think of it like a snowball effect, but in reverse, where the interest ball grows bigger and bigger before you start making a real dent in the principal. The amortization schedule for a 30-year loan front-loads the interest, meaning you're essentially paying for the privilege of borrowing for a longer time up front. On a 15-year loan, you're paying down the principal much faster from day one. This accelerated principal reduction means less interest accrues over the life of the loan. It's a powerful financial lever, but it demands discipline. Understanding this fundamental difference is key to avoiding the long-term interest trap. A common myth is that you can simply take a 30-year mortgage and just pay extra each month to match a 15-year payment, achieving the same savings with more flexibility. While it's true that paying extra on a 30-year loan will reduce your interest, it's not quite the same. The interest rate on a 30-year loan is almost always higher than a 15-year loan. So, even if you make the same monthly payment, you're still paying a higher interest rate on the 30-year option, meaning less of your extra payment goes towards principal compared to a true 15-year loan. Additionally, life happens. When financial times get tough, it's easy to stop making those extra payments on a 30-year loan, falling back into the longer amortization schedule. With a 15-year, you're contractually obligated to pay it faster, forcing that discipline. So, while flexible extra payments are good, they don't fully replicate the true 15-year benefit. But what about the risk of tying up all that cash? Here's what happens if you choose the wrong term. I once knew a couple, let's call them Sarah and Tom, who bought their dream home with a 30-year mortgage because the lower payment felt more comfortable. They had good intentions of paying extra, but then unexpected medical bills hit, followed by a job loss for Tom. Those extra payments stopped immediately. 7 years into their mortgage, they realized they had barely touched their principal due to the front-loaded interest. Their equity growth was minimal, leaving them little flexibility when they needed to move for a new job opportunity. They essentially paid hundreds of thousands in interest without much to show for it in equity. If they had opted for the 15-year, even with its higher payment, they would have built substantial equity much faster, providing a cushion for life's inevitable curveballs. This story isn't unique. It's a common trap many homeowners fall into. So, how can you avoid this kind of regret? The main argument for a 30-year mortgage is financial flexibility. A lower monthly payment frees up more cash flow for other priorities. Investing in a 401k or Roth IRA, saving for college, starting a business, or simply building a robust emergency fund. If you choose a 30-year term and then aggressively invest the difference between its payment and a 15-year payment, you might potentially earn more through market returns than you'd save in mortgage interest. This strategy requires discipline and a strong understanding of investment risks and rewards. However, it also means you remain beholden to mortgage debt for longer. For some, the peace of mind of being debt-free sooner outweighs potential investment gains. The key is to run the numbers for your specific situation and consider your risk tolerance. But what if you're not sure you can handle the higher payment? What if you want the interest savings of a 15-year but are nervous about the higher payment? A smart strategy is to take a 30-year mortgage but intentionally make extra principal payments each month, as if it were a 15-year loan. Many mortgage lenders allow you to specify that extra funds go directly to principal. This gives you the best of both worlds: the lower required payment of a 30-year for flexibility during tough times, but the option to pay it off faster and save on interest when you can. Just be sure to double-check with your lender that extra payments are indeed applied to principal and won't be held for future payments. This approach requires self-discipline, but it provides a safety net that a true 15-year mortgage doesn't. But what if you're a first-time homebuyer with limited funds? Your initial mortgage term also impacts your future refinancing options. If you start with a 30-year loan and interest rates drop significantly a few years in, you might consider refinancing. However, if you've been on a 30-year track, you'll still have a substantial principal balance. Refinancing into a new 30-year loan could effectively restart your amortization schedule, potentially extending your debt repayment even further than your original loan. On the other hand, if you've been on a 15-year track, your principal would be much lower, making a refinance into another 15-year or even a 10-year term much more manageable. This can lead to even greater interest savings down the line. Always consider your long-term financial goals when choosing that initial loan term, as it sets the stage for future financial maneuvers. So, what specific steps should you take? A 15-year mortgage makes incredible sense if you have a stable, high income, a substantial emergency fund, and limited other high-interest debt. If you can comfortably afford the higher monthly payment without stressing your budget or neglecting other financial goals, the long-term interest savings are undeniable. It's also a fantastic option if you're nearing retirement and want to be mortgage-free before your income potentially decreases. The accelerated equity buildup also gives you more financial power, whether it's for future investments or simply peace of mind. For those with a clear path to financial security and a desire for debt freedom, the 15-year term is a powerful tool. But what if your situation is more uncertain? Conversely, a 30-year mortgage is often the better choice for first-time homebuyers, those with fluctuating incomes, or anyone prioritizing cash flow and financial flexibility. If a 15-year payment would stretch your budget too thin, leaving no room for emergencies or other investments, the 30-year is the safer bet. It allows you to enter the housing market, start building equity, and still have funds for life's necessities and opportunities. This is especially true if you plan to move within 5 to 7 years, as the interest savings on a 15-year loan might not fully materialize in such a short time frame. Remember, homeownership is a marathon, not a sprint. Choosing the right term means balancing immediate affordability with long-term financial goals. So, how do you make the ultimate decision? Here are your actionable steps. First, get pre-approved for both a 15-year and a 30-year mortgage from multiple lenders like local credit unions and national banks. Compare the actual interest rates and monthly payments for the exact same loan amount. Second, calculate the total interest paid for each scenario using an online mortgage calculator. Seeing the full numbers laid out is crucial. Third, assess your budget honestly. Can you comfortably afford the 15-year payment, even with unexpected expenses? Will it prevent you from saving for retirement or an emergency fund? If you choose a 30-year, commit to making extra principal payments when possible. Finally, consult with a financial advisor to discuss your specific financial situation and long-term goals. They can help you weigh the pros and cons in the context of your overall financial plan. Don't rush this decision. It's one of the biggest you'll make. The choice between a 15-year and a 30-year mortgage is more than just a number. It's a foundational financial decision that impacts your wealth and peace of mind for decades. Understanding the math, recognizing the interest trap, and aligning the loan term with your life goals is paramount. Whether you prioritize aggressive debt repayment or maximum financial flexibility, the key is to make an informed choice. You've now seen the powerful impact of both options. Think of the hundreds of thousands of dollars at stake and choose wisely. If you found this deep dive helpful, please consider subscribing for more insights into navigating the U.S. real estate market and making smart home buying decisions.